explain the phenomenon of the London fix. Every day, 4 o'clock London time, the Forex price benchmark will be set. It gets quoted by Reuters and several other banks. Now, the price fixing itself is more a mechanism of if traders or globally want to buy or sell assets, they can use that particular price as a benchmark. Which also means if I call up a bank, I'm a big investor and I live in Japan for instance, I want to buy any particular asset, they will be quoting me the prices based on that benchmark that's been set for that day. That is the main mechanism behind the price fixing. So everybody can do business around that price. But it also means that those particular banks, they need to have inventory of currencies for that price. That's why you can see a lot of volatility sparking and back and forward around London fix, especially to the run up of it. And you find that it comes or prices drop off after that as well. So it's always a push and pull around the London fix. There are two main things we are never sure about. We're not sure if the London fix is going to create a reversal, which it does sometimes, the price itself or the movements going into it. Because a lot of times there's a lot of big orders going into the London fix itself, which means that particular asset managers around the world or traders are bullish or bearish on a particular FX move. Or two, we are never sure if that price fixing is just going to have an effect for the rest of the day. But here's the thing that we cannot ignore. It's a supply and demand imbalance that creates. And supply and demand traders usually look for significant moves in the market where price pulled away in a market level, call that a supply and demand level, and they will trade off of that. I'm trying to bring the logic behind the supply and demand imbalances for you. Based on the London fix on a daily basis, you can get to see them every day. The currency pair I like to use for the London fix price analysis is the GBP/USD. It's one of the more mechanical assets to trade. That means you find that price is, or the currency pair is very reactive to certain price points. Every day on a daily basis, the fixing price for the London fix, I will mark those out. And you can see how price reacted after it and before it. So London fixed price for instance, the 22nd of June, and you can do this with any other day as well, was around the 24.46 level. Rolling over to the next day, we had price swings going back into the level and bouncing sharply back, which acted as a significant demand level. Moving up, actually price managed to pull up quite a bit after that. The following day we had a price fix at around 25.22. Now we never know again if price is going to go up or down or just going to stay choppy. What we know for sure is the price will react to the London fixed price levels. So if I see a pullback and a sharp move back into it, it usually means I'm going to see some sort of a reaction. Now the reaction could be 20 pips. The reaction at some instances can be 500 pips. There's a more greater understanding needed to understand why market is moving and what are the drivers for the month or for the week. But to keep it simple, to keep it just as straightforward with the London fix, I mark out the London fix price on every single day. And if I'm bullish and price is trading underneath it, it will be a bad idea to start buying into it, as I'll be having a strong supply level. On the other hand, if I'm bullish, I'm waiting for price to climb above it and possibly give me a smart rejection so I can get a sharper stop loss as well, which increases our ability to manage our risk. So here around the London fix again on the day before, price graviated a lot about it, gave us a couple of rejections, dropped above it, came above it, and it seems to be playing along quite neatly. I've marked out the London fix for the following day for you as well, and price pulled sharply away into the following day, and it did not manage really to create some sort of breakthrough after that. I'm gonna delete the a couple of days before, as we're usually just concerned about that particular date for the London fixed price. And the following day, price dropped significantly from the London fix the day before, so the 25th reacted to that, and on the 26th the London fix came in quite low. Interestingly, market traded back into that level, so the 26th would have been the weekend, and on the following Monday market traded into that level, and it showed some sort of a noise before dropping further down again. On the 29th, they had a new level created, which inevitably gave market a great price level to create a springboard on and scale higher. And you find these things a lot, especially if you're in a strong, momentous-driven market. Getting into a trade is very difficult because you're not sure where you should place your stop loss. You're not sure when you should enter or where you should enter. And the London fixed supply and demand imbalances will give you incredible opportunities to get into this trade. So here we had some sort of a bottoming pattern, prices pulled away. The following day the London fix came in at about 23.55. If you were bullish here and you wanted to buy, you would possibly need to suffer a much greater stop loss around these levels, which is near to over 100 pips stop loss to capture some sort of upside. If you would use the London fixed price as your springboard, so to say, you would just need to wait for price to retrace back into it. That will give you some sort of entry with much tighter stop loss management. And indeed, price is traded sort of back into those levels and create another springboard, and so on and so forth. So I want you to keep an eye on the London fix on a daily basis, as these are true supply and demand imbalances, not something you can always see on the chart. They are more logical driven, where we know real orders went through, we know there's real business being made around those price levels. They're always significant to market, regardless if you're bullish or bearish. They always can create a little bit extra structure in your trading. There's another price fix on a daily basis, which is a little bit less significant. Nonetheless, especially if you're trading the Asian session, it becomes much more apparent, and that is the Tokyo fix. I believe it's about 8:55 Tokyo time, which works out to be closer about 1 o'clock the London time. That is a price fix as well. There's moves around the Tokyo price fix aren't incredibly strong, but still the levels are key, more or less. So if I remove these drawings and just mark out the London fix, the Tokyo fix from the 1st of July was around that. Prices really reacted to the zone, climbed underneath it and struggled to get above it, essentially moving it as a springboard to move higher into the next day. And we have a look at the price fix for the following day, and that again is the beginning of the month. So we had the price fix around here. Market managed to trade Asian session bullish, New York session bullish, and surprisingly this was after the NFP, so prices dropped back into the Tokyo fix and kind of played around that level, for the rest of the day until it found it sort of breaking away. So you find these price fixes are significant, especially if there is a lot of push and pull in the market, especially if you're in a strong momentous driven market and you need to get a springboard to get into a trade so you can manage your risk much better. These London fix and Tokyo fixes to some extent create exceptional opportunities, and these are really the true supply and demand imbalances we see in the market, and that particularly works across all FX pairs. In GBP/USD you find that it works to the pip, where the other FX pairs price is a little bit more erratic. You find it spikes 5 to 10 pips beyond the fixes, where with GBP/USD much more mechanical and much more concise as well. So I hope you make use of the supply and demand imbalances with around the London fixes. It is a strong strategy and a strong tool to have to even trade on its own, or in conjunctions when you do trend trading or swing trading as well.